Inflation, it's a hot topic and it's coming. Well, in fact, inflation is already here. And in this video, I'm going to walk you through how inflation impacts your real estate investments and a benefit of inflation you probably didn't expect. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. I'm Seth Ferguson. Let's get right into it and talk about inflation. Like I said, inflation is already here. Gas prices are going up, cost of goods are going up, foodstuffs going up, everything is going up and up and up. And like I talk about all the time on this channel, we always look to the past to determine future performance of an asset. We always look at the past 3 recessions to see how it performed, but inflation is nothing new. Sure, in the short term, we haven't had rising inflation, but in the grand scheme of things, inflation comes and goes. And we look back to the 80s, and we can look at how real estate performed in a period of high inflation. And the cause of the inflation in the 80s, we can go back into the 70s, talk about the gold standard, all of that stuff, but that's another topic for another video and possibly another YouTube channel. So for today, let's talk about how inflation will impact your real estate investments. And first of all, it's going to impact your expenses. Because like I said before, everything is going up. This is going to include your cost of goods if you're doing renovations or turning units. It's going to impact the labor costs of doing those turns. It's going to impact your staffing because wages will eventually increase with inflation. All of these things are going to impact your bottom line. So when you're modeling a future investment, or maybe you're in the middle of a current investment, you're going to want to modify your modeling for your remaining years to make sure you're taking into account rising expenses. So for many years, people were using 3% for annual expense growth. Well, that's going to have to go up if we're seeing rising inflation rates above 4 5%, depending on where we end up. So I would always rather overestimate inflation and inflation's impact on your expenses rather than underestimate. So right now, if we're hitting whatever it is, it's going to depend on when you're watching this video. Just err on the side of caution. Really overestimate inflation's impact on your expenses. Now, on the subject of expenses, one thing I did not mention was utilities. And this is where it becomes very, very important to institute programs where we can either bill back to the tenants or have direct billing depending on your setup. As utilities, the cost of gas, electricity, and water goes up because inflation will be pushing it up. You don't want to be shouldering that. You want to pass that through to the tenants who are actually using the utilities, so that way that's not going to eat into your profits at the end of the day. So whether you can implement a RUBS program or a direct billing, that is going to save you a whole lot of grief because that takes it off your shoulders. And again, the tenants must be responsible for their usage. And at the end of the day, it is not up to you to subsidize the utility costs for the tenants because you don't want to be getting stuck with that if you haven't built that in to your modeling as the price goes up. Now, how do rents get affected in periods of inflation? Well, this is why real estate investors love real estate, and especially multifamily real estate, because real estate is a natural hedge against inflation. So think of it as, let's say you're fishing and you have the bob on top of the water. Let's say you're fishing with a small kid and you've got the bob so they can watch it. That's like real estate. It's going to keep you afloat because the rents are being charged will naturally increase with inflation, and same with pricing. So as rents go up in a multifamily context, because this is a multifamily real estate channel, what you want to do is, let's say you have 100 units. You want to make sure you're turning a sufficient number of units every year so you can keep pace with that rising cost of inflation. Because let's say 50% of your new units stay occupied for 3 years, you're going to be lagging behind. Let's say inflation hits 6%, 5, 6, 7% a year, and your rents are still at year 1, you're going to want to be able to turn a sufficient number every single year to keep pace with that rise. Now, rents will keep pace, and I'm talking about an overall market pace, but you as an investor, you want to make sure you're turning a sufficient number of units every single year or every quarter, whatever you're going to base it on, to make sure you're keeping pace with those rising costs. Another way inflation will impact your real estate investing will be in your returns. Let's say we're dealing with a 15% annualized IRR, just using that as an example. Well, and let's say inflation was at 2% before. We're really dealing with a 13% annualized IRR at that point if inflation stays consistent at 2%, right? Because that 2% is being eaten off by the rising prices. Well, now let's enter in 5% or 6%, 4%, whatever it tends to be. Your return's going to be shaved off. So investor expectations as a passive investor as well as an active investor, you have to work this in to your modeling to make sure that the investment you're looking at has sufficient upside, so that way you can actually keep pace and not get into that treading water situation. And especially we see lots of times with investments where some deals where the margins are so thin, there's not a lot of meat on the bone. Well, this is where you really have to dig deep and look hard into those deals and just make sure you're going to be coming out ahead when you factor in the cost of inflation. Now, I did allude to a benefit of inflation you probably didn't think about. So let's talk about a benefit of rising inflation. And this is going to center around our debt. So we know that the cost of goods, cost of living is going to go up because inflation is going to be pushing it up. And we also know that because the nature of real estate, especially multifamily real estate, the rents are going to go up and pricing also will get pushed higher by inflation. That's if we go back in time and look at every single time we've had inflation. Real estate is cyclical. What happened before will happen again. Now, what happens to the debt on the deal? Bear with me. So let's say we have $1 million asset, and let's say we have a fixed mortgage. Let's say it's 50% leverage, so a $500,000 mortgage. And like I said, it's fixed. And let's say we have a 10-year term on it, and we're in year 3. So that means we have 7 more years of this term of fixed payments. So the cost of it, our expenses are going up, the rents are going up because we're turning consistently. So everything's being pushed up, but our fixed mortgage payments remain the same. So this is a benefit because what's happening is inflation is eating away. It's actually lessening the impact of your debt. So if we have $1 million asset at the start, and just through inflation and the rising prices, that asset goes up to 1.3. And again, I'm just making up these numbers right now. Just bear with me with this example. So if inflation increases the price and artificially inflates it to 1.3 million, our debt cost has remained the same at 500,000, and same with our debt service payments. Nothing has changed. So each and every year, our debt obligation, even though the amount is the same, is being eaten away, slowly lessened by inflation. So basically, the equity left in our property at the end of the day is growing. This is a benefit to us because when we look at our debt service ratios and the amount of equity you have in the property, more equity is better. And then you can probably go back, refinance, pull out some capital, and that is inflation at work right there, but working in your favor. So these are just some things to consider as we're getting back into a period where inflation seems to be going up. Just keep in mind your expenses. Work that into your underwriting. Always make sure we're keeping pace with our rents and turning over a sufficient number of units to keep pace with that, and just setting realistic expectations in terms of returns. And then just remember, even though it can be stressful with everything else going on, inflation will eat away at your debt obligation, eat away at the impact of your mortgage, which is not a bad thing. So if you are interested in learning more about investing in multifamily real estate, join my free Facebook group, link right down below. It's a great group of people who are always happy to help. And if you like this video, if you found this useful, hit the like button, leave a comment, let me know what you think. And until next time, happy investing.